All right, what's happening? It's Tuesday morning, 10 a.m. We're doing some live financial modeling here, as we do most of the days in the beginning of the week. Mobile home park. So I had a original version of this in like 2017. Last year, I upgraded it to account for 40 separate parks building out, and I also added a whole bunch of different logic to it for better just revenue and expense assumptions. What we did yesterday was added in some formatting and tabs for income statement, balance sheet, cash flow statement, as well as dynamic depreciation. And I did a little bit of the income statement, well, most of it. So, as you know, the plan is, this is, I counted it out. This is the 16th startup model I've upgraded so far this year, which is basically upgrading it to have the three statement modeling logic and cap tables. This won't have a cap table because it's more complex of a joint venture. We just have three waterfall options. But the goal here is to hopefully finish this out probably tomorrow, but I'm going to get really far on it today. And we'll go from there. The biggest upgrade we're doing now, besides having formal financial statements, is we're going to add in depreciation logic for each of the parks that are purchased, acquired, and or developed. They could be either or. They're going to have some useful life, and you've got depreciation over time. Then when they're sold, this will be the cost basis. And uh, before I begin, check out smarthelping.com. Don't forget. This is actually the model I'm doing now is part of the industry specific bundle, which, where is it? Mobile home park, the third one right down here. And it's also part of um, you can also get it in a category or volume bundle. It's part of the Ultra templates, or you can just buy all the templates on the site. And I've been working on this for 6 years, and there's a lot of value behind everything that's built here. Tons of value. So check that out. Also, if you want, subscribe to the YouTube channel. Let's go ahead and post the live link over to Twitter. And good to go. Let's do a quick test. Make sure the sound's working, and then we'll get started here. Test. Test. Okay. Sounds good. Awesome. So so yesterday what I was doing was trying to figure out uh, how we do taxable income, and what I decided was the easiest way this is going to be is to have operating income and tax on that and logic for that, and then sales proceeds and tax on that and logic for that, based on these two tax rates. So exit of the parks versus other operating income. And what this allows you to do is, if you have a basis, well, because the idea is when you build a park, this is you have property, plant, and equipment as a line item. This would basically be property, and there's some value here, and it's a gain on sale of fixed assets, not just ordinary income. So we're doing a separate tax bracket for that. There's a lot of nuance here, and you have to consult a CPA to get better details. I'm not a CPA, but I do know it's going to be useful to have these two rows separated. So then essentially what we have is tax on sale, tax on operating activities. Now what I want to do is bring this over to the annual tab, because that's where we have to reference and know if there was a, you know, profitable operations or not for the year. Which, if you're continually buying new parks, you probably, because of the depreciation that you can expense out, you're probably not going to have operating profit until you finish building out all of however many you're going to do. It doesn't have to be 40, it could be, 5 or 10 or whatever. But you'll see that because of all the depreciation, you won't have much tax until you're done building out. All right. And there's bonus depreciation, um, accelerated, all that. There's all kinds of different things with these mobile home parks that are pretty tax beneficial. All right, so let's make the annual look just like this. Want total depreciation in row 50. Okay, and then this is all getting redone. So we want this to be in 52. Now, because I'm redoing like all of this, I'm gonna have to manually do the formulas and logic with the three statement modeling, and it's gonna be harder, but we're just gonna have to do it like that to make it work right. So taxable operating income. Well, first let's just do the top part. So this matches the monthly. So we go sum ifs, and actually let's adjust here. Just make sure we're all matched up. Okay, perfect. So this is going to be sum ifs, monthly row, if the year up top on the monthly equals the year here. So there's our total. Now we want to lock so we can drag and drop this thing all around. So there's that. Take the sum. Okay. Vacancy loss. And then this is now going to be a plus instead of a minus. All the OPEX aggregated from all 40 or up to 40 operations over time. Interest. Okay, let me make sure. So this, okay, it does stop at the end. Perfect. The real fun stuff is going to be when we try to get this balanced out with what's happening on the monthly and annual detail here, because there's quite a lot of things to not mess up. You've got pro formas for 40 parks here, and just there's a lot going on, so that'll be fun. Hopefully we're all matched up if I do a good job here on the references. All right, so this looks good. Let's put in depreciation. Okay, looks good. Now, since we are already messing with the spacing, we're just going to remove these spaces now because it won't matter. Might have to redo all the logic on the three-statement modeling stuff. Okay. So here's our income statement. Now, the trick. First, we have taxable operating income, which is taking earnings before interest, tax, depreciation, amortization, subtracting interest expense because that's tax deductible, subtracting depreciation because that's tax deductible. So for as far as operations, here's your taxable income. So you can see it doesn't get positive till after year 4. And you can see here we're building out and through year 4. 22, 2023, 24, and 2025. So 4 total years. So that's why you're seeing operating loss as those are building, and it's mainly because of this depreciation going on. Now, all these numbers are arbitrary. Obviously, when you build this out, you're going to put in all your own assumptions for all of this, for what the parks cost, what the operations are, what your useful life is on these mobile home parks. My job is to make sure the logic works, so when you play with the inputs, it all works and makes sense. So there's taxable operating income, taxable sales proceeds. Did I reference? So I referenced 1905 on the monthly detail. Let's see, what was that? Total exit proceeds. Okay, so that's the total of everything exiting on that month, and that's based on this exit month here, whatever it might be, this cap rate, and any seller fees or pre-penalty fees. Okay, so that looks good. We can just sum that up from the monthly. So there's that. And then we put, so the tax on the sale, yeah, that's fine, that's fine. So the tax on the sale is going to be whenever that sale happens, it's just going to be this number minus your cost basis. So this is the gain on the sale. So our total cost basis at the end of the template is going to be 8.8 million across all these, and that's just based on the total cost minus the total depreciation that happened over the life of the operation. Now we'll have to make an adjustment here. This is going to be, we'll have to put net gain loss and I mean there's no way, it's very rare if you're going to sell this and have a loss, but so we'll probably just put gain in here, net capital gain on sale. So this number is going to go up here. Now the trick is on the depreciation schedule, we have to stop depreciation on the end month. So if we end the model and depreciation is still going on, we have to stop it. So if this is greater than the end month of the whole forecast, zero it out. All right. So these are 15-year useful life. So most of them will not be done depreciating, but we have to zero that out because we can't count December depreciation if it doesn't exist past November. So this total cost basis has to take that into account. So here actually we're depreciating less, so the cost basis is a little bit higher than what it just was. This makes sense. So we want to take 9.4 million against the total sales proceeds. and we're saying now, and this gets real complicated. You definitely, if you're dealing with this kind of money, you'd have a tax professional helping you, but I do know you'd have to do these, partitions out here to figure out what the numbers should be. So we're doing that here. So we got taxable sales proceeds is going to be based on this capital gain. So we have this, lock this cell. So whatever's in here minus that. We don't need this actually. Oh wait, let's put this up. Just trying to make this flow easy so it's easy to follow. So this is total sales proceeds, 371. Cost based on depreciation, 362. So you got a little bit of a lower cost basis here. Now, this cannot be below zero. So, well, no, let's just say if this exit year equals this, then do this, otherwise zero. And then we'll set that to be the year. So if year of R5 equals Control E7, and then let's put that in here, equals year that. Okay, so sales proceeds, capital gain, and oh, what did we not lock? Control E has to be locked as well. Now there's probably a percentage of this, percentage of sales proceeds that can be applied to this cost basis, and some of it can't because you're also selling like the operations. So we'll have to do a slicer in here. Let's move this. We're gonna have to say a percentage of sales proceeds that can be applicable to the, let's just say it's 60%. This will be a percentage of total exit proceeds applied to property So we have further granulation. So we have the total sales proceeds up top. Oh, hold on, let's go to the annual because we're doing it here. So total sales proceeds. We need to do sales proceeds assigned to fixed assets, which is property. Sales proceeds assigned to other income. And honestly, these tax rates like for joint ventures, they probably do taxes after the distribution, so it wouldn't matter. But for a single operator, you'd want to know this stuff, so I'm putting it in. All right, so then here's we have on taxes, um, capital gains, percentage total sales price applied to property, and the rest would be applied to other income. Now the other income portion would then be taxed at this rate. So if not assigned to property, okay, so we want to do 60/40. So let's show that. So this number times 60 is measured against capital gains. This amount times 40 is measured against other operating income. All right. So net gain would be, we take this number minus that number. This is other income. Then we also have this as other income. So let's move this around. So taxable operating income. So those two are taxed at the same rate. And then how do we want to structure this? So total sales proceeds, sales proceeds, other income, sales proceeds, and fixed assets. So here's one calc. Here is another one. And these two are taxed at the same amount. So tax on sale is this amount times here. Tax on other activities would be sales proceeds plus this times this rate. And there's your two taxable numbers. Okay. So there's that. This obviously can't be below 0, so max of this and 0. And then we have net income, which is just net income would be EBITDA minus interest minus depreciation plus sales proceeds assigned to other income plus sales proceeds times fixed property. Hold on, let's think about this. Wait a second. Let me just drag this over so I'm not, this is distracting me. All right, so net income, we only want profits. The cash flow will capture all the other stuff. So for profits, we want EBITDA. Essentially, actually, we can start with taxable operating income plus net gain on sale plus sales proceeds assigned to other income, so that's just profit, minus taxes. Okay, so there's that. And again, if you don't want to deal with, you could actually, if you don't want to deal with taxes, you could zero all this out. And if you don't want to plan an exit happening, you could also put a 0% cap rate. And then, shoot. So for this, let's think about it. So the cap rate is 0. We need to show a 0 if it's an error. Let's see. Monthly detail, 1905. So here we can just go if error 0. So we can flow to the rest of the model. Okay, nice. So that worked. And then, yeah, you just have, so if you weren't doing a sale, you obviously wouldn't be having any capital gains or losses. So this, if exit assumption equals 0%, then zero that out too. So that just kind of says you're just running, you're just showing operating activities, acquisition and operations to the end of the 16 years, but you're not counting any exit or taxes. Then you get something like that. Let's put this back in here. So let's say 5, whatever, and then what did I have? It's 25, do 40, and then 35. All right, so this looks good. Got our net income here. Now the fun part is going to make this balance with the balance sheet. But we will try to figure it out here. All right, well, income, let's see, we don't need, we do need active, let's see, do we need this? Yes, because if we have partial year, we need to know to not calculate taxes for all 12 months. We don't need a trailing 12 month anything. So let's get rid of all these. because we're not using, yeah. And then we want control referencing D7. Well, no, that D7 is the exit. We want greater than or equal to the start month. All right, so this should allow us to get a good count of active months for tax purposes for each period. Okay, well, first we need to just match this. So 34. Oh man, okay, we can't just do that. All right, so what sales proceeds is in 34. Okay, let's just copy this over. Total sales proceeds. This is tricky because taxes are coming based on if the annual net income is positive, but then we got to pull some that back to monthly, but then the annual runs off a lot of the monthly numbers so we've got to make sure we don't have any circular reference errors and all that. So taxable operating income. Okay, that's good. Then we have sales proceeds assigned to other income. Now this number, let's copy this in here. $289,042. Okay, looks good. Then we have these two. This is going to be total sales price times that, and then net gain is, so that should be fine as well. $192, $183. All right. And now, tax on sale, tax on operating activities. Hold on. We now don't need the year, we just need to do if GL5 equals D7. Perfect. Okay, and then that, and then So on the monthly, I want to sum up the annual divided by the active months in the period. So tax on the sale is going to be sum ifs this amount if this equals this. And then to get the monthly, we want to divide that by, divided by sum ifs this is 1. So sum if that's 1, or no, sum if 51 if the year here is the year. And let's try that. Okay, and then we want to say if this equals 0, then 0. So really, the tax on the sale, we're amortizing over 12 months. We don't actually have to do that anymore. We just have to do that with the operating activities. The tax on sale happens in that month. So on this, all I actually need to be doing is summing up the total tax. And only if this end month equals this month. Otherwise, 0. So there we go. We got the 45,805. Now, so that's taxes of this. We need to do tax on this separately as well. So we can do really simple. This amount times control this. Plus, let's do one more row. So this is tax on sale proceeds not assigned to assets. Tax on operational activity. Okay, so that's that. I'm gonna add that in here too. So net income to 43 now. Oh wait, that's right. Tax on sale. This is gonna be, what did I say it was? It's the 45. So this is, wait. So this is this number. Tax on the sale. Net gain on sale. Tax on sale. Proceeds not assigned. So this is then assigned to other income times this number. it up. And then now we don't have to add these two together. We just do it based on operating income, 35. It's just that. So we got 41 split between these two. Sales proceeds is E42. Yep. Assigned to other income is E42. Let's make sure E is this one. Yep. So this is property. This is other. Then we've got assigned to fixed property. We've got the net capital gain based on the value of depreciation happening. Then we've got taxes on the sale. Based on the capital gains. We have tax on the sale, proceeds not assigned to fixed assets, so this number is at a higher rate. We have tax on regular operating activities. So let's redo this one. So this operating income is going to be EBITDA minus interest minus depreciation plus sales proceeds assigned to other income plus net capital gain minus tax minus tax minus tax. Okay, so that's good. Now let's see, do we do it here? Oh, this is so, there's a lot going on here. Okay, so now this we have sale proceeds, net gain, net capital gain on sale, tax on sale, tax on sale. What do I do on this one? So the first one is capital gains. So that we just take this amount times this. All right. And the 101 we have that matches that. And then we need a 2.6. So this is a tricky one. The 2.6. This is a tricky one. So sum up taxable operating income if the year matches the year here. So that's the total. $7,556. Okay. So total taxable income divided by this if this is oh man, I'm losing it. Listen to all right, hold on. So we know the total yearly tax is 7.5 million for operations. We need to divide that into months to evenly fit each month. And we're only doing this because we know it's positive. So we need to just know the number of active months. So divided by sum ifs, count this if this range is equal to this. And then if this date is greater than end month, then 0. See, this is what happens when I have to do it from scratch. It's way harder. Normally on these upgrades, I don't have to do this because it's all, we don't have such complexity that we're seeing here. Let's drag this over. All right, and obviously this is not ever going to be 0, so we do max of this and 0 because you can't have tax on negative profit. Okay, let's pull this into here. Well, now let's see if it matches. So, in theory, sum of all of this minus net income of monthly should match. What? All right, we're out. I figured we would be. So 33 million. So if we sum up all of this, we're at 352,668, and this is 319. So this is lower. So now we got to figure out why. Let's look at the taxes here. Make sure this matches for the year. 7556. Nope, this is 2 million. So tax is 2 million. Oh, I see. So I messed up on this one. So we want to actually sum up income statement 42. We just want the tax, not the taxable income. So that's one thing. That might be all of it, actually. Let's see. Because technically here you've made 7,556. Tax on that is 2.6 based on that tax rate. Yep, that was the error. Okay, so now we're actually completely balanced. That's good. That's good. I like that the monthly has this all in the month of the sale. That kind of makes this easier, makes sense with the net income. Let's make sure we have no errors. Let's say we move this to the end month. Okay, looks good. Let's say we move it back. Let's say no exit happens. Okay, good. And then let's say if we don't want the taxes. Perfect. All right, so it looks like our logic's flowing pretty good. Alrighty. Well, we can move on now. This is, man, this is really a lot of value add to a model that was already super in depth and comprehensive, because Uh, this will now give a lot better insight into anybody that wants to look at this. And you can plug in all these assumptions and then see formal financial statements. Just super beneficial. All right, well, we've got income statement, I believe, fully built out as it needs to be, complete with exit assumptions and everything else. Now, the next part is we go into cash flow statement. Let me check something real quick. Okay. So, cash flow statement, we want to see just what's happening in cash flow. So, customer receipts would be like revenues. So, we'll take the total. Now, this is tricky because so total potential rent's not an income number. We actually want to take gross rental revenue. So, this is the actual cash received. Other OPEX. We want this number, and we're summing this up, so this needs to come through as a negative. Interest is going to come through as a negative as well. Taxes, lots of taxes here. Negative on this, minus this, minus this. Okay, so that's the cash flow from all operations. Okay. So here's like your EBITDA, these two combined, and you've got interest, tax, depreciation is a non-cash item, and it's not included here. I think that's everything. Then we go capital expenditure. So what I want to do here is we're going to have to pull. So this is going to be basically the totals of this over time. We're assuming that's all CapEx. And the accumulated depreciation on those purchases over time is going to be the aggregate of this. All right, so let's see, on the monthly detail, do we have that labeled somewhere? Let's look at the first one. So what am I calling initial cost? So I want to sum up everything that's labeled initial cost per month. Now make sure initial cost doesn't show up in any other text rows. Initial cost. No, I think we're good there. So what I can do is go sum ifs. Here, if column C is equal to, if it has any text saying initial cost. And that will be a negative number. And really, so this is purchase is development. MHP purchase acquisition development land. Okay, so there's that. Sale of, okay, so here we want the total sales proceeds. And that's going to be we could either go income statement and take this. I guess we just take this number. Oh wait, I've separated them out. So sale of business would then be a sale of other income, and then sale of depreciable assets would be what's assigned to depreciable assets here. Okay, now we drag all this over. And there's that. Now this can get crazy. So on the debt, I've got literally 40 amortization schedules here, all with the same terms with timing based on whenever each park is starting. So you can see how these are dynamic. So let's see. What did I do on the monthly roll-up? Cash required for construction renovation, cash required for acquisition, total cash for purchase construction. So here, total funds equity. Let's think about this now. So equity is each purchase is actually funded by some debt. We still need to count the total value for the balance sheet, but for cash flow purposes, this total amount essentially goes out, but we also have borrowing that comes in to pay that out. So borrowing would be this number. And then principal payments, let's see, I'm praying I separated that out. Nope. Oh, yes, I did. Nice. So what did I do here? I did debt service. So this is principal plus interest paid refi. So this is all tax deductible interest. No, it's not all tax deductible. It's all of the debt service. And then this is just principal, which is that against total debt service. So this is saying principal repayments don't start until, now why are they starting all the way over here? Let's see. So this is everything. Principal, interest paid. So it's this, this. Oh, let's go back to where is it? On the amortization tab, it's principal, interest paid refi. So it's this principal payment, interest paid on the refi loan plus interest paid here. So total interest Total principal, total debt service. So I've got interest in month 1. So what am I doing here? Where can I get the right number? Why am I not paying principal back? There's $5,000 of principal being paid here. All right. Equity requirement is taking net operating income less debt service. Oh, okay, so I'm already counting debt service in this. Which is cash from operations minus debt service. Now, debt service including principal, I just want principal repayments. All right, so what I'm going to do, I see. I can reference this here, total principal. So anything here for each of these. All right, so total principal is going to be sum ifs, monthly detail E, if C is equal to or has the text total principal. There's the 5,607 I was looking for. Now we can drag this over. Let's make sure we didn't miss anything. So all that principal is getting paid back. Now, sale of company stock. So this is actually going to be called equity contributions. And that is simply going to equal where is it? Equity, this number. I believe, let me look back here. So this is just saying if the net operating income after debt service is less than 0, then take whatever that number is. So essentially any operational burn minus the total acquisition construction plus initial loan amount. Otherwise, just do cost plus that. And I'm assuming this goes to 0 after we stop buying stuff. Yeah, okay. All right. Now the only thing is, yeah, that's fine, that's fine. So on the company side, this is actually a positive number of cash coming in. And let's see, how do I calculate contributions here? Annual detail F1906. Okay, so 1906, let's go to the monthly. So it's just all, yeah, all it is the sum of this. So same thing. All right, so that's good, makes sense. All right, now, I mean, the question is, did we capture everything? The change in cash flow. We're going to find out when we measure our cash balance against the operations and everything. But I believe we did. So we've got taxes, that stuff. All right, so now the hardest part of this whole thing is going to be calculating the balance sheet. This will be the hardest part for sure, no question about it. Okay, just got a email about a person who purchases that wants the updated version when it's done, which I will be sending. So again, if you've bought any of the templates that are being upgraded, just email me and I will send them. Okay, so cash. Uh, we should simply be able to look at the cash flow monthly equals that. And then the next day it equals the same thing plus the previous amount. Yeah, we got to check. So cash flow annuals all messed up. So this is just some if cash flow monthly 9, if the year here matches this. Then we lock 3 and D3. Now technically we should be able to just drag this down and get the total value per year. And this total 698.25. 698.25, 706, 70, wait, 76. Yep, okay, good. So on the company or on the MHP Acquisition LLC side, we have all the activities from operations, we have all the activities from investing, we have all activities from financing, and that equals total actual change in cash flow. Now here we're not solving for zero. Like in some of my other startup models, it'll figure out the total burn and startup costs and figure out the initial capital required up front. This is doing it on a monthly basis over time based on the acquisition schedule here, whatever that might be. In this case, we're just buying one park; they're all the same cost in each month. All right. So that cost goes out, but then we're borrowing some money, so that comes in. We're paying principal. We've got equity contributions coming in. Principal repayments, this is a negative number. So there's our solve for zero right there. We're basically just borrowing just enough money to cover all of any burn of operations plus the acquisition requirement of equity on each one. So borrowing is paying this back. Let's make sure we're not double counting anything. Okay, so here, what is this saying? Net change in cash negative. So we're borrowing just enough, just enough, just enough. Then we have some positive operational cash flow. Now, why do we get negative here? Probably because of the refinance stuff happening, I'm assuming. Yeah. So we've got principal payments going from here up to here on the refi. I need to account for refi cash in. So hold on. Let's add that in. I knew I was missing something. Because we're accounting for refi, so if that happens, you're paying, yes, a bunch of principal back, but you're also getting proceeds to do that with. So refi cash in. And now that number, let's see where we track that number. It would be refi disbursement. Okay, so we just do, where's our calc here? This one. Except for we're looking at refi disbursement. And it's not a negative, it's a positive value. So make sure to add that. Oh, shoot. And you can see, watch, right when this gets negative, it's not actually because you're getting a refi in that month. So you're paying down 2.7 million of the initial loan, but you're refining here. Your debt service is going up. You can see interest going from 500, it's going about 30,000 up here. Here it only went up 88, 14. So all that logic is dynamic in this amortization schedule for each park. It's got its own initial loan. It could possibly have interest-only periods, and then the refi as well. If you select that on the control tab here, if you mark this as yes. All right, we're making progress. Let's drag this all the way over. Yeah, because I was confused. There shouldn't ever be a negative cash flow month. It should always be 0 or positive, and it'll be positive when your operating income is greater than your debt service. Okay, so now let's add that to the cash flow annual. All right, let's make sure this matches. So 265, 101, 265, 101. Okay, nice. So there, let's get back to the balance sheet. So cash here, that plus that. And then we end. So those are current assets. Just basically cash is our only current asset we're going to be tracking. The other thing is current assets, not or non-current assets. So this is going to be property, plant. It's basically going to be property. We're going to call it that. You can label it whatever if your accountant instructs you, whatever you want, but we're going to call this property. And this is just the cumulative value of all of the acquisitions or development costs. Now here we can simply say it's going to equal this number plus the previous amount. And clear all this. And then we'll have accumulated depreciation on that, which is going to be income statement monthly, simply this number. Oh, not that one, this one. And it's going to be negative. It's a contra asset, one of the only contra assets there are. So negative total depreciation. And this is going to be the same thing minus the previous month. So as these things start to get depreciated, now wait a second. Oh, right, because we're not starting depreciation until the amount of months until revenue starts. Now I'm wondering, actually, we probably should start it in the very first start month when the money first goes out, in theory. Let's change that. So if I've got acquisitions here, I've got also in depreciation age 45. So start month here. Yeah, I did an E date. I don't want the E date actually. I just want the start date. Now let's make sure this still works. So this should be 366 total. Okay, good. All right, so that we got accumulated depreciation. Drag this over. Okay, and we're still stopping in November. Yep, okay. So there's that. Oh, this will be a tricky one. So long-term debt. All right, so long-term debt is total borrowed less total principal repaid. So we have, I wonder the best way to calculate this. I guess it'd be the sum of the ending balance of this and this. So sum ifs, and this is the first month of the model, if this equals ending balance. So that is the total of everything over time. Okay, good. And it ends here and then it goes to 0 on the exit. Okay, good. Okay, so outside, so this is just going to be one number. It's just going to be called equity contributed, and this will just simply equal this accumulation of that number. All right, we're getting there. We're still not balanced, but we're, 850,000 retained earnings. So here is simply going to be the net income. And this is where things get crazy with financial statements. How this balances out, I do not know. It's almost unknowable. No, it is, but it's just so elegant. I don't know how they figured this out so long ago, this accounting system, but it's pretty cool. All right, so there's retained earnings. And so let's see, what's this differing by each time? 40. All right. That could be. This is where things really are gonna get hard with this, but it's where things get more why the template gets more valuable. So 20,503. What could I possibly be out by in the first year? So what has happened? We have basically no cash. We've put all the cash into the properties. We borrowed just enough money to do that. This is the value of what we bought. It's got some depreciation happening for the first month, right? Income statement, depreciation. So our total assets would be cash, that, and this. Long-term debt, 2744, which is just the amount we borrowed. Let's just do a check on this. So it would be this amount minus principal. And we know our principal is here. This amount, 2744392. Okay, so that's that number. That makes sense. Where did I just calculate that at? Monthly, okay. So that makes sense. Total cash contributed and then retained earnings. So what is the variance here? And I'll probably have to stop streaming here shortly because this is going to go on. This is definitely taking me all day tomorrow, maybe go into Thursday. This is where things are going to get really difficult. Let's think about this though. So cash, let's go to cash flow. We've got some interest, which is included in the income statement. The hard thing is it's not just one number. We're out by a number that's I can't just see easily. It's kind of close to the accumulated depreciation, but not exactly. So make sure we're counting everything. What could it be? Probably something with retained earnings. So let's think, if we're taking 937 as contributed from equity, hold on, 20 million, 20,503, is that what we're out by? Yes, okay, okay, we found it. All right, so we're out by this number here. Net operating income less debt service. So I believe it's this number, debt service including principal. So there's got to be some reason why, how are we going to account for that? Because then the accumulation of this debt service is what we're out, 574, July 2022. Well, there might be other stuff. Oh, excuse me. Well, let's see. So somewhere we must be double counting that debt service somehow. So this equity contribution, let's just go through this again. 19 operations minus that minus debt service minus all debt service. Hmm. So where should that 20,000 be? Well, we're down, so this needs to be higher in theory, this 916. Oh, wait a second. Hold on. Equity contributed 937. Hold on a second. I referenced the wrong cell, I think. AK27. Hold on. Equity. Oh my goodness. It needs to be D. I'm an AK. Holy cow. Well, I love when it's a problem like that. It's not a huge issue. It was just the reference. Oh man. So that plus this. All right. Now, probably the only other variance is going to be on the exit. I'm assuming we'll have to do some stuff there. Yeah, this 121. Okay, so good news, we figured that out. There's still, and once we figure this out, this is like the hardest part of the whole thing, so we'll be basically done. So this looks like what happened in August? August. We're up by exactly it looks like the acquisition amount. So why would what changed here? Are we, let's see, so August 2022, August 2022 should be K27. Yep. Okay, so that looks good. Ah, assets stopped going up. Assets stopped going up. Now, why is that? So, AM, oh my goodness, so another misreference. All right, cash flow statement monthly. D. D should be the next one. Let's drag this over. I was gonna say 25 million seemed low. That is low from what has happened. All right, we are balanced on the monthly. Oh, what was that? What? Oh, this is just a reference. Okay, so yeah, we got to update. This should just equal sum of all of that. Okay, and then yeah, the end months are gonna be. We'll have to do some stuff there. I already know that. Otherwise, looking good. So this is really, really good. We are all balanced on all this complex stuff. It's just we'll fix up the exit. Let me make sure we have no references to the other workbooks on here. Nice. So this is an example of why accounting is so interesting in Excel, because the formulas here, look at the formulas aren't complex. It's simple plus minus formulas, but it's the knowing what goes together and how to formalize the financial statements is where you get all the complexity. All right, I'm really happy. Our cash flow statement, monthly and annual, is done. Income statement, monthly, annual is done. Balance sheet monthly is almost done. We got to finish the end here, and then we'll do the annual, and then we'll do some sanity checks. We are definitely going to finish this tomorrow. I'm pumped. This is a great upgrade. I didn't remove any logic, so the model still has everything it had originally. All I've done is add in these 1, 2, 3, 4, 5, these 6 financial statement tabs. It's still got, the waterfall option is all these things still work just like they did before. Um, no effect by adding these statements. The only thing I would say is I might possibly want to add in the effect of taxes, which are not on here right now at all, which would affect the waterfall available to distribute. Um, other than that, so taxes, interest, all this stuff is already in there. Fine. This is already in there. Let's look. Hold on. The annual sales proceeds 300, 492. Let's just make sure. Yep, 300 million, 492. The MHP detail still makes sense, so you can see each property on an annual basis over 16 years. Net operating income, costs, initial loan amount, refi, debt service total, exit value, net cash flow of each one individually. If you wanted, you could run an IRR on this. You can put an IRR here for each one. And in total, That's pretty cool to have in here, I think. Now, now these numbers are based on the timing, and the big numbers hit probably because, yeah, so this is always the month after the 12 months. So you've got 12. So we're adding one a month. So here, the reason why you get a big pop is it's the beginning of the next year. It's getting essentially the max juice out of the investment. So that's why you see bigger IRRs on month 13, 25, 37. Yep, that all makes sense. And then these are the last ones. Okay, yeah, that makes sense. Um, so there's that. We've got obviously the front control tab tells you all the total IRRs of sponsor investor based on those waterfalls. So this would change a little bit if I add in taxes. Um, Everything else is already accounted for. And then I'm going to check, obviously, and make sure that the cash flow happening in these matches with the monthly and annual detail because it's the same data, so it should, if I add in the tax effects. All right, well, that's awesome. I'm out for the day. I will be back in the morning tomorrow, 10 a.m. We're going to keep going on this. We'll finish it up. Again, don't forget to subscribe. Check out smarthelping.com. We've got, this is part of the industry specific template bundle. Right here at the bottom, this mobile home park is what we're currently working on. It's a $175 model purchase. Um, don't forget, you can also check out all the financial models on the site. We've got bulk discounts by volume and category. Here's the category color code key. You can buy all the templates on the site for $1,000, $9.99. I feel like that's the value that you get out of all these. There's over, there's probably 130 templates here, all unique in different industries for HR tools, accounting tools, startup models, uh, joint venture waterfalls, all sorts of stuff here. All right. Have a good one. I'll be back tomorrow. We're gonna keep grinding on this. Really, I'm really happy about how this MHP. I was gonna skip it honestly because I knew it was gonna be difficult, but now that we're through it almost, I'm really happy we've added this logic. It's just another improvement, and no price change on it. All right.